Welcome back, traders and investors. It's time to talk options here with Larry McMillan, founder of McMillan Analysis Corp and OptionStrategist.com. Larry, how you doing this morning?
Great, great, thanks.
I was thinking about the conversation that we had last time, and we're talking about your overall strategies and your overall portfolio, and how you always kept some kind of insurance on your overall portfolio, your overall stocks. Now, that hasn't been a very rewarding proposition over here with this raging bull market. But I guess if you're putting on, small hedges that cover a lot of risk, you're doing okay. We're with the S&P making a new high yesterday at 1980.50, not following through much. Are you still sticking with that strategy? Do you need or to reload?
Oh no, we're sticking with that strategy. It's tried and true. Basically, we're still bullish on the market. So we're operating, as you said, with a modest hedge. But hedging is very cheap right now. We are buying volatility calls as our hedge. You could also buy S&P 500 puts, or if you have a portfolio that sort of simulates the Nasdaq, you could buy MDX puts, that sort of thing. But they're all cheap. I mean, volatility is very low, and that's why options are cheap now. And, I'm not saying it's going to explode, but you never really know. I mean, last week with the Ukraine mess, and then the fighting in Gaza, it looked like something could start to fall off the rails, but it really didn't. We just had that one day when the volatility indices spiked up and the market went down on Thursday, but then we recovered right away. So volatility has actually fallen again. And sort of as an aside, there is a trading signal that we look at in terms of the VIX, and it did give another buy signal as of Friday's close. So that signal is it's usually very strong in the first 10 days, but it kind of has influence for about a month. So we're operating under that buy signal now too. And as you pointed out, the market did not make a closing high yesterday, although it did make a new intraday high in terms of the S&P 500. I would expect it will soon make a new closing high. In fact, it's probably going to open there again this morning. It's up, the futures are up about 3.5 points. But I think the thing you really need to keep your eye on in terms of the market in general is the S&P 500 chart. It's been the best guide, really. It hasn't violated support for a long time, and even though we do occasionally get sell signals from other things, for example, breadth has not been really all that great in the last couple of weeks. But the S&P 500 chart just holds support every time. Right now, that support's about 1950, and it kind of modestly tested that. Last week, I think the low was more around 1960. But that's what we're kind of using as we're not necessarily trading in and out of the market with our strategy. If you recall, we are basically sellers of puts and taking in premium, and we spend some of that premium on protection, although not all of it. But as far as sentiment goes, too, put call ratios are pretty interesting to look at, and that has turned negative. But I would not rely on put call ratios over just the general trend of the S&P 500 chart.
Now, so you have these hedges on all the time. So obviously, when we had the turmoil last week with the commercial airliner going down, and the sell-offs in the markets, do you ever? I mean, obviously, if you had those hedges on previously, they showed some green for you. Are you tempted to take them off, or do you stick with your rules that these are long-term hedges and that you're not going to scalp a short-term profit and risk giving up long-term protection on your portfolio?
Yeah, we're more towards the fact that they're long-term hedges, but that doesn't mean we would never take a profit on them. And I wouldn't generally take a profit on the first day, which is we really only had one day of bad action there, which was Thursday. But in general, what we would like to do is, if volatility did start to trend higher, we'd roll our hedges up. We own calls at a certain striking price, so if those went in the money, then we take a profit on those and buy newer, cheaper ones at higher strikes. So we call that rolling up. And so we'd roll our protection higher in that case. I mean, in 2008, when you get into a really long trend of higher volatility, we were able to do that several times. But we wouldn't normally do it on the first day.
Okay, and also just now going back to more general talking about options, and I know you've written your book Options is a Strategic Investment. What is the most common mistake people make when they start trading options?
Well, typically, you start trading options, you sort of view it as a lottery ticket. You think, oh boy, I can buy this option for 50 cents and, maybe cash it in for $8 later on or something like that. You hear about, stories on TV or you see advertisements about it and that sort of thing. But in reality, people, rather than trying to stick to maybe a discipline of trading stocks, they are just buying these out of the money options that don't really have much of a chance of making a profit. And then even though maybe you only lose 50 cents, that's 100% of your investment. So that's the biggest mistake. People, even good stock traders who try to move into options for the first time, usually end up doing stuff like that. But more experienced traders who are, say they're fairly successful at picking stocks and that will, trend higher, they should be buying in the money options so that you're really almost using the option as a stock substitute. That's what the professionals do. Right now, in fact, with options being this cheap, a lot of institutions are able to sell out stocks and buy in the money calls
Yep.
for very little premium to replace them with.
Right, and then they have a defined risk on the call purchase. We're going to throw a stock at you here today, and I don't know if anybody had options on Puma Biotechnology, PBYI. I don't know,
Right.
Larry. Have you seen the chart on this one this morning?
Well, I saw it what it did yesterday or last night actually. Yeah, they were talking about it. Um, there was a minor clue there that
Really?
these biotech stocks, people know that they're going to, in this case, release the results of a drug trial, and that's not a defined date. The company, will not come out ahead of time and release a date when they're going to say that, as opposed to say a regular FDA hearing when they would have a specific date. But when the implied volatility of the options goes higher, in other words, when the options get really expensive, that's sometimes a clue to, at least we feel, a clue to buy a straddle on the stock. You buy both a put and a call because you don't know what's going to happen. If they'd have come out and said, this trial we were working on was terrible, and the stock might have fallen, 30%. So it's crazy, and I did not have a position in it, but I did see that the options were expensive. So obviously, some people were, looking at that as being a potential volatile stock. We call those event-driven situations when the options get very expensive in front of an event, and sometimes that can be in biotech stocks, something like this, or in regular earnings. That happens too, and in certain stocks, not every stock, but some stocks.
You mentioned that you will write puts also. That can often be a risky strategy. If you write puts on something and it has a serious decline, how do you manage that risk?
Right. Well, we're writing puts on the broad stock market. In individual stocks, it's much harder to manage the risk. So what some people do is they'll sell a put and then buy a farther out of the money put. That's called a put credit spread,
Hmm.
and that's their approach. Our approach is to sell the out of the money S&P 500 puts, and they are generally more expensive because there's demand for those. And then, as I said, we buy volatility calls as protection.
So everything you're doing, you're not when you're putting a leg on, you're putting another leg down somewhere else at least to cap your risk. You're never going with unlimited risk in any of your strategies. Is that correct?
Right. Well, eventually. Well, first of all, we don't know for sure that volatility will go up when the market goes down. from this level, I'm very confident that it would. But sometimes, it can be higher. In like 2009, I mean, the market did have that pretty bad fall in the beginning of 2009, and volatility really didn't go any higher. So there is risk. I'm not saying there's no risk, but we try to hedge it. Yes, we do.
Okay, so with the market here bumping up against all-time highs, still confidence in the move higher. You have some downside protection as well. With the market being at these elevated levels, if you're looking to put money to work, is there a particular sector right now that you think that's been perhaps a little bit overlooked and may be worth an investment?
Uh, yeah, well, we don't do a lot of sector work, but I have. I'm going to kind of change that a little bit. All of these takeover rumors and these takeover situations that have come to the front lately, have a lot of them have really panned out quite well.
Correct.
So I think when you see these, like this Time Warner situation, for example, the options are not that expensive in there. Another one that's a takeover rumor that's been acting very good is TRW. So I think selectively you can pay attention to these. You have to read the news and maybe not so much listen to the stuff you hear on television, but read through the news, see if it makes sense, and you can take positions in these. So I don't know if you'd call that a sector, but
No, no,
it's a
that's
segment.
no, that's interesting because Dennis and I have talked about that in several stocks. How you got the initial surge, and then rumors kind of die out, and then they kind of come back to come back near or at the level that they were at, and then things resurface again. So that's whether you're playing the equity or the option, and we were just talking about a potential takeover in the energy sector too with Talesman Energy and Respro. And hey, if there's something out there enough to get the rumors going, sometimes things do come to fruition. Well, I asked you about stocks or sectors that you thought and you mentioned the takeover area. Is there anything in your portfolio or in the overall market that's looking a little frothy to you?
Well, I mean, there's really, I don't really have any shorts on right now at all. So I guess the answer to that question would be no.
Okay. Okay. All right. We've had Larry McMillan on. He is the founder of McMillan Analysis Corp and OptionsStrategist.com. He's a person who's been doing options for 35 years, so his wisdom and outlook is always appreciated. Larry, thanks for coming on the show. We'd certainly like to have you on again.
All right, thanks for having me, and I'd be glad to be on again, sure.
It was great.